Hey, fellow investors, ever wondered how to create a steady stream of income that keeps flowing regardless of market turbulence? Dividend investing might just be the answer you're looking for. It's a powerful strategy that can help you build wealth over time while providing regular cash payments just for owning certain stocks. I've spent years refining my approach to dividend investing, and today I want to share with you 8 crucial rules that have helped me build a reliable income stream. These aren't just theoretical concepts, they're practical guidelines that can help you create a sustainable dividend portfolio for long-term wealth and consistent cash flow. Let's start with what I consider the golden rule of dividend investing. Prioritize dividend growth over high yield. It's tempting to chase those stocks with eye-popping yields of 8% or more, but this can be a dangerous trap. Companies offering unusually high yields often can't sustain them long-term. Instead, I focus on companies that consistently grow their dividends year after year, even if they start with more modest yields. For example, companies like Walmart recently increased its dividend by 13% in February 2025, extending its impressive streak of annual dividend increases to 52 years. Have you noticed how these steady growers often outperform the flashy high yielders over time? The second rule is to always check payout ratios for sustainability. This ratio tells you what percentage of a company's earnings are being paid out as dividends. Generally, a payout ratio between 40% and 60% is considered healthy, giving companies room to reinvest in their business while still rewarding shareholders. When I see ratios climbing above 80%, it raises a red flag. The company might be stretching to maintain its dividend. Johnson & Johnson maintained a payout ratio of 55% in 2024, striking that perfect balance between shareholder returns and business reinvestment. Third, I always focus on companies with strong cash flows. Free cash flow, FCF, is the lifeblood of dividends. It's the cash available after covering operational costs and capital expenditures. I look for companies where dividends are comfortably covered by FCF. Take Apple, which generated a massive $110 billion in free cash flow in 2024, easily covering its dividend payments and share buybacks. What would happen to your income stream if you invested in companies that can't cover their dividends with cash flow? Diversification across sectors is my fourth rule. I learned this lesson the hard way during market downturns. By spreading investments across different industries, utilities, consumer staples, healthcare, technology, I've created a more resilient income stream. When one sector struggles, others often pick up the slack. Remember, about 90% of the benefits of diversification come from owning just 12 to 18 stocks. My fifth rule is to look for dividend aristocrats. Companies that have increased their dividends for at least 25 consecutive years. These companies have proven their commitment to shareholders through various economic cycles. Caterpillar, for instance, has paid a regular dividend without fail since 1933 and has increased its payout every year for 30 years. NextEra Energy, another aristocrat, raised its dividend by 10% in February 2025. Wouldn't it be reassuring to own stocks with such reliable dividend histories? The sixth rule that has dramatically accelerated my wealth building is to reinvest dividends whenever possible. This powerful compounding effect can significantly boost your returns over time. When you reinvest dividends, you're essentially buying more shares that will generate their own dividends in the future. I've watched my portfolio grow much faster since implementing this strategy consistently. Patience is the seventh rule, and perhaps the hardest one to follow. Dividend investing isn't a get-rich-quick scheme. It's a long-term wealth-building strategy. I've learned to stay patient and avoid market timing. The real magic happens when you hold quality dividend stocks through multiple economic cycles, allowing those dividend increases and reinvestments to compound over decades. Companies like Archer Daniels Midland have paid dividends for over 92 years, recently increasing their quarterly payout to 51 cents a share in February 2025. Finally, I regularly monitor dividend safety. This eighth rule has saved me from several dividend cuts over the years. I watch for warning signs like rising debt levels, declining earnings, or unsustainable payout ratios. Companies with low debt-to-equity ratios and sufficient operating income to cover interest expenses are typically better positioned to maintain their dividends. When a company reduces its dividend, I follow the survival of the fittest rule. I sell and reinvest the proceeds into more stable businesses. After all, stocks that reduced or eliminated their dividends had a 0% return from 1972 through 2013. I've found that following these 8 rules has helped me build a reliable income stream that grows year after year. The beauty of dividend investing is that it works in all market conditions. You'll still receive those dividend payments even when markets are down. And as your dividends grow over time, so does your financial independence. What dividend investing rules have worked best for you? I'd love to hear about your experiences in the comments below. If you found this information helpful, please hit that like button and subscribe to the channel for more investing insights. Don't forget to turn on notifications so you never miss a new video. Thanks for watching, and I'll see you in the next one.